At exactly 6:47 p.m. Pacific time on January 10th, 2026, something unprecedented happened in the 74-year history of American central banking. Federal prosecutors served grand jury subpoenas to the Federal Reserve, threatening criminal indictment against Chair Jerome Powell over his testimony to Congress about a building renovation project. The charges seemed bureaucratic, almost trivial. The reality was revolutionary. For the first time since the Federal Reserve achieved independence in 1951, the American president was weaponizing the justice system against the nation's central banker. The timing was surgical, markets closed for the weekend, news cycles dominated by other crises. A moment when the most powerful economic institution in human history could be attacked without immediate financial chaos. But Jerome Powell understood what was happening. In an extraordinary video statement released Sunday evening, the normally reserved Fed chairman made an accusation that should have sent shockwaves through every financial center on earth. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. The language was diplomatic, but the implication was clear. The President of the United States was attempting to criminally prosecute the Federal Reserve Chairman for refusing to manipulate interest rates according to political demands. This wasn't oversight. This wasn't accountability. This was economic warfare against the institutional foundation of American financial power. The building renovation that triggered the investigation was real. The Fed's headquarters modernization had indeed exceeded budget projections, reaching $2.5 billion from initial estimates of $1.8 billion. Cost overruns on government construction projects are routine, typically handled through congressional oversight and administrative review. They don't typically result in criminal investigations unless fraud or corruption is suspected. But fraud wasn't the issue. Corruption wasn't the motivation. The building renovation was a pretext for something much more dangerous. The real target was Federal Reserve independence. For 74 years, the Fed has operated under a mandate that insulates monetary policy from short-term political pressure. The central bank's dual mission of maximizing employment and maintaining price stability requires decisions based on economic data rather than electoral cycles. This independence is what allows the dollar to function as the world's reserve currency. It's what gives international investors confidence that American monetary policy won't be manipulated for partisan advantage. Trump had been attacking that independence for months. Public statements calling Powell too slow and incompetent, threats to sue the Fed chairman over construction costs, demands for immediate interest rate cuts regardless of economic conditions. The pressure campaign had escalated steadily, but criminal prosecution represented a line that no previous president had crossed. The line between political criticism and institutional destruction. The mathematics of Trump's demands revealed the dangerous logic driving the investigation. He wanted the Fed to cut interest rates aggressively to stimulate economic growth and reduce government borrowing costs. Lower rates would boost stock markets, increase consumer spending, and improve GDP statistics that Trump could claim as political victories, but the Fed had already cut rates 3 times in late 2025, reducing the federal funds rate from 5.5% to 4.75%. Further cuts would risk rekindling inflation that had only recently returned to the Fed's 2% target. Powell's resistance to additional rate cuts wasn't political, it was mathematical. Inflation data showed persistent pressure in housing costs, energy prices, and service sector wages. Employment remained strong, with unemployment at 4.1% and wage growth accelerating. Traditional monetary theory suggested that additional stimulus would create more inflation risk than employment benefit. The Fed's decision to pause rate cuts reflected economic analysis, not political defiance. But economic analysis wasn't what Trump wanted. He wanted compliance. And when Powell refused to provide it, the Justice Department received instructions to find legal grounds for removing him. The building renovation provided the perfect pretext. Complex construction projects always involve cost changes, schedule adjustments, and communication challenges. Prosecutors could frame normal project management as misleading Congress, turning bureaucratic complexity into criminal liability. The strategy was brilliant in its cynicism. Instead of directly attacking Fed independence, which would trigger massive market backlash and congressional opposition, the administration could claim it was simply enforcing accountability in government spending. The criminal investigation could proceed under the banner of fiscal responsibility while actually functioning as intimidation against monetary independence. If successful, the precedent would transform every future Fed decision into a potential criminal liability. The global implications were staggering. The Federal Reserve doesn't just control American interest rates. It controls the cost of dollar-denominated debt worldwide. Trillions of dollars in international bonds, corporate loans, and government securities depend on predictable Fed policy based on economic fundamentals rather than political whims. If monetary policy becomes subject to prosecutorial pressure, the dollar's role as a reliable store of value collapses. International markets began pricing this risk immediately. Gold surged to all-time highs above $2,600 per ounce, as investors sought alternatives to dollar-denominated assets. The yen and Swiss franc strengthened as flight-to-safety flows moved toward currencies backed by truly independent central banks. European bond yields fell as international capital sought refuge from American political instability. The message was clear. If the Fed could be criminally prosecuted for economic decisions, American financial assets carried political risk that other investment destinations didn't. But the investigation's impact extended beyond market movements. It struck at the foundation of institutional credibility that enables the American economy to function. Central bank independence isn't just about interest rates, it's about the predictability that allows businesses to make long-term investment decisions, banks to price loans accurately, and governments to finance operations at reasonable costs. When monetary policy becomes subject to prosecutorial interference, every economic calculation becomes political speculation. The international precedent was equally dangerous. Authoritarian governments around the world had watched Trump's success in weaponizing government institutions against political opponents. Viktor Orban in Hungary, Recep Erdogan in Turkey, and Jair Bolsonaro in Brazil had all attacked central bank independence using similar justifications. Economic accountability, fiscal responsibility, democratic oversight. The language was always reasonable. The result was always political control over monetary policy and economic instability that followed. Turkey provided the clearest example of what happened when presidents gained control over central banks. Erdogan's dismissal of central bank governors who refused to cut interest rates despite rising inflation had destroyed the lira's value, triggered massive capital flight, and created economic chaos that persisted for years. Turkish inflation reached 85% at its peak as markets lost confidence in monetary policy independence. The economic damage extended far beyond Turkey's borders as international investors reevaluated political risk across emerging markets. Trump's attack on Powell threatened to bring similar dynamics to the world's largest economy. The Federal Reserve controls the global financial system's foundation currency. If American monetary policy became subject to political pressure, every international transaction denominated in dollars would carry additional risk premiums, global trade would become more expensive, international investment would become more volatile. Economic relationships built over decades of predictable American monetary policy would require fundamental restructuring. The institutional damage was already spreading beyond the Fed. Trump's Justice Department had been systematically targeting government officials who resisted presidential demands, FBI agents who investigated Russian election interference, intelligence officers who reported unfavorable information about foreign leaders, environmental scientists who published climate research contradicting administration policy. The pattern was clear. Government employment increasingly required political loyalty rather than professional competence. Powell's criminal investigation represented the most dangerous escalation of this pattern. Unlike other government agencies, the Federal Reserve's independence was specifically designed to resist political pressure. The Fed chairman serves a 4-year term that doesn't align with presidential cycles. Board members serve 14-year terms to provide continuity across multiple administrations. The entire structure was created to prevent exactly the kind of political interference that Trump was now attempting through criminal prosecution. Congressional Republicans found themselves facing an impossible choice. Supporting Fed independence meant opposing a Republican president's law enforcement priorities. Supporting Trump meant endorsing the destruction of institutional independence that conservative economic theory considered essential. Some, like Senator Tom Tillis of North Carolina, chose institutions over party loyalty, announcing opposition to any Fed nominations until the criminal investigation was resolved. But most remained silent, unwilling to defend Powell against their own party's leader. The silence was telling. It revealed how completely Trump had captured Republican political infrastructure, even when his actions contradicted decades of conservative economic orthodoxy. The party that had historically championed central bank independence, limited government, and rule of law was now watching their leader criminalize economic disagreement with presidential demands. The transformation was complete. American conservatism had become simple loyalty to Trump's personal interests. Democratic opposition was vocal but ineffective. Congressional hearings, media statements, and procedural objections couldn't stop a criminal investigation authorized by the Justice Department. The separation of powers that was supposed to protect institutional independence was failing when one branch captured the prosecutorial apparatus to attack another. Powell could defend his actions publicly, but he couldn't prevent prosecutors from pursuing charges that would destroy his career and intimidate his successors. The investigation's legal foundation was deliberately flimsy. Federal prosecutors claimed Powell had misled Congress about the renovation project's costs and timeline. But congressional testimony frequently involves complex projects with changing specifications and uncertain outcomes. Construction cost overruns are normal, not criminal. If misleading Congress about project costs became a criminal offense, most of the federal government would face indictment. The selective prosecution of the Fed chairman revealed the political motivation behind charges that would never be pursued against other officials. Powell's defense team understood the impossible position they faced. The Justice Department had unlimited resources to investigate every aspect of the renovation project. Any communication that could be characterized as misleading, any cost estimate that proved inaccurate, any timeline that wasn't met could become evidence of criminal intent. Complex infrastructure projects always involve miscommunications and revised projections. Prosecutors could construct a criminal case from normal project management challenges if they were determined to find guilt rather than truth. The broader message to Powell's successor was unmistakable. Trump had already announced his intention to nominate a replacement when Powell's term expired in May 2026. That successor would take office knowing that resistance to presidential demands could result in criminal prosecution. The independence that had protected previous Fed chairs was gone. Future monetary policy would be made with one eye on economic data and another on prosecutorial threats. Financial markets began pricing the long-term implications of politically controlled monetary policy. Stock prices became more volatile as investors recognized that Fed decisions would increasingly reflect political cycles rather than economic fundamentals. Bond markets demanded higher yields to compensate for the additional uncertainty of prosecutorially influenced interest rates. Currency traders reduced dollar exposure as the greenback's stability became dependent on American political outcomes rather than economic strength. The international response was swift and damaging. European central bank officials publicly defended Fed independence while privately questioning America's commitment to institutional governance. Asian central banks began discussing alternatives to dollar-denominated reserves as American monetary policy became less predictable. The G7 finance ministers issued an unprecedented statement expressing concern about political interference in member countries' central banking operations. But the most significant response came from China and Russia. Both countries had been seeking to challenge dollar dominance through alternative payment systems and currency arrangements. Trump's attack on Fed independence provided perfect propaganda for their efforts. Why hold dollars if American monetary policy was subject to criminal prosecution? Why trust a reserve currency controlled by prosecutors rather than economic analysis? The attack on Powell became a recruitment tool for countries seeking alternatives to dollar-dominated international finance. The timeline for financial system disruption was accelerating. Powell's term as chairman expired in May, but his position as a board member continued until 2028. Trump faced a strategic decision: attempt to prosecute Powell immediately, or allow the investigation to intimidate his replacement while keeping the criminal threat in reserve. Either approach would damage Fed independence, but immediate prosecution would trigger maximum market volatility during a period of international economic uncertainty. Powell's response revealed his understanding of the stakes involved. Rather than quietly accepting the investigation or negotiating a face-saving resignation, he chose public confrontation with unprecedented directness for a Fed chairman. His video statement was carefully crafted to educate the public about central bank independence while exposing the political motivation behind criminal charges. The measured tone couldn't disguise the revolutionary nature of his accusations. The American president was criminalizing economic disagreement. The investigation's outcome would determine whether American institutional independence could survive concentrated political assault. If Powell was successfully prosecuted, every future Fed chairman would know that resistance to presidential demands carried criminal liability. Monetary policy would become an extension of White House political strategy rather than independent economic analysis. The 74-year tradition of Fed independence would end, replaced by prosecutorially enforced compliance with presidential preferences. But success wasn't guaranteed. Congressional oversight could expose the investigation's political motivation. Market pressure could force reconsideration of policies that threatened financial stability. Legal challenges could establish precedents protecting Fed independence from prosecutorial interference. International criticism could create diplomatic costs that exceeded the domestic political benefits of controlling monetary policy. The Federal Reserve had survived previous attacks on its independence. During the 1970s, political pressure for accommodative monetary policy had contributed to inflation that ultimately discredited interventionist approaches. During the 1980s, Fed Chairman Paul Volcker had resisted enormous pressure to avoid the painful interest rate increases needed to break inflationary expectations. Market credibility ultimately proved more valuable than political popularity. Economic reality eventually forced acknowledgement that central bank independence served long-term prosperity better than short-term political convenience. But this attack was different. Previous pressure had been political and public. Congressional hearings, presidential criticism, and media campaigns could be answered with economic arguments and market results. Criminal prosecution was a different category of threat. It couldn't be answered with data or defended through democratic debate. Prosecutors could indict based on technical violations that had nothing to do with economic policy. The rule of law was being weaponized against the institutional independence it was supposed to protect. The investigation represented a test of American democratic institutions under authoritarian pressure. Would congressional Republicans choose institutional preservation over party loyalty? Would financial markets punish political interference strongly enough to force reconsideration? Would international partners impose diplomatic costs for abandoning central bank independence? Would American voters recognize the threat to economic stability posed by politicizing monetary policy? The answers would determine whether the United States retained the institutional foundations necessary for global economic leadership. Central bank independence wasn't just about interest rates. It was about the predictable, rules-based governance that enabled the dollar to function as international money. Lose that independence, and the economic foundation of American global power would crumble along with it. The lights were still on in the Federal Reserve Building. The staff continued working on economic analysis and monetary policy implementation. The machinery of central banking continued functioning as it had for 74 years, but the investigation had changed everything. For the first time since 1951, the Federal Reserve operated under the threat that economic decisions could become criminal liability. The independence that had made the dollar the world's reserve currency was under attack from within, and the outcome of that attack would determine whether American economic leadership survived the assault of its own president against the institutions that made that leadership possible.